My presentation is on the AK6 kimberlite, discovery through to production, but very importantly the subtitle here, about learning the lessons of history. So you will see that I often refer to political and economic contexts at that particular point in time. Now my reference point in terms of the AK6 kimberlite, which is now known as a Karowe mine, was that I was General Manager Exploration for De Beers, who did most of the original work. I then moved to African Diamonds, where I was Managing Director, and following the sale of the AK6 project to Lucara, I was Vice President of Lucara. So what you'll see here today is all publicly disclosed, by the way, just so everybody knows that. There's nothing that's kind of confidential or private to either of the three particular companies. But I think you'll find this is a very, very interesting story. Firstly, I must salute why we're actually here. And I'm delighted I can show this particular picture here. So Manfred, it's wonderful to meet you for the first time too as well. Seeing I run a public company, this is all very important, disclaimer and disclosure, okay? Never mind, moving on. Right, so the agenda of my presentation is as follows. I'm going to firstly talk about the discovery, and I know Manfred is here and he was involved in it, so I hope I get this part right. Then the evaluation of the kimberlite itself, which I led, the mining, which will be familiar to all of you right now. And then very importantly, I'm going to talk about the corporate context at that particular point in time and why it was seen as being a sub-marginal project to being probably one of the world's greatest diamond mines. And then I want to spend more time actually on the lessons learned. What does this mean for you, for me, and for others in terms of diamond exploration going forward? So firstly today, the Karowe mine, as we all know it, this is taken from the Lucara's website. It's yielded just under 2 million carats, generating revenue of $1 billion at an average price of $566 per carat. So if you remember anything from this side, please just remember $566 a carat. Not only that, but it's famous for its absolutely fabulous Type 2 diamonds. In particular, the Laserde La Rona, which is the second largest diamond ever found. Please also remember the point about Type 2 diamonds, because it's going to come back time and time again throughout the project itself. So where are we? We're in the Orapa province of kimberlites. The Orapa province of kimberlites is probably one of the most prodigious in terms of diamonds and diamond mines in the world. There are 85 kimberlites in the province, with 8 having been or are mines, and of course the world-class Orapa mine, which is the world's largest tier 1 diamond mine at 118 hectares. Of course, it's not the world's largest diamond mine. That belongs to Petra and Mordui. We're celebrating 50 years of diamond exploration history here in Botswana too. And this is also the theme of the International Kimberlite Conference, of which I borrowed this slide. But maybe some of you don't know, but diamonds actually took place, the looking for diamonds, the exploration for diamonds took place well before that. And I'd just like to read this quote. I don't often like to read from a slide, but I'd like to read this one from a chap called W.J. Makin across the Kalahari Desert in 1929. Diamonds were the obsession of this old prospector. He clasped his glass of Cape Brandy in his sunburnt and calloused hand and told me of a mythical diamond field in the Kalahari that would make Kimberley seem an absurd little pothole. And how true Mr. W.J. Makin was. Now, sadly, you'll have to go and buy the second-hand book. It's not available. But another equally interesting book by Lieutenant F.C. Cornell of 1920, The Glamour of Prospecting, is available on Google Books if you actually want to read it. And I encourage you to look at all of these kind of historical artifacts. It sets a very firm and interesting foundation for where we are now. I'm not going to dwell too much on this slide because it has been covered by others previously in terms of the rich diamond tapestry of Botswana itself. And this continues today. If you look at diamond exploration around the world, you probably have more diamond exploration activity happening here alongside Canada than actually anywhere else. And that's a testament to what many have referred to this morning about the strong relationship between industry and the government and the vision of the government itself in terms of producing a very stable and predictable fiscal environment for Botswana. And that's why people come here to invest in the country and to develop new diamond deposits. So that was just my brief introduction before I dive straight into the discovery of AK6. AK6 was discovered by De Beers, or De Beers Prospecting as it's called, in 1969. And at that time, it was viewed to be 3.3 hectares, had poor mineral chemistry, and had a low diamond grade of around about 3 carats per 100 tons. So, of course, it was considered low interest, and people just moved on. But you must remember the context of that time, and Manfred spoke about that this morning, is they just discovered the world-class Arapa mine. So what would a small 3-hectare body be of interest to them at that particular point in time? So if we look at this discovery in context, what can we learn from this? And the learning part is the most important part of this presentation for me. There was only a very small data set for garnet mineral chemistry. So it was understated, and it didn't reveal the true extent of the garnet mineral chemistry. The extent of the basalt breccia was poorly understood due to limited drilling, and therefore the kimberlite was undersampled. And the point number 4, which I'm going to return to time and time again, because it's something that we're still learning, is that there was excessive diamond breakage through the drilling and bulk sampling process. So people walked away from it. One must also remember at that time, in the 1970s and 80s, and I'm not sure how many of you know, many of you wouldn't have been here at the 1970s and 80s, but at that time there was economic stagflation in the world. High inflation, slow growth, high unemployment. There was a major stock exchange crash during 1973 and 74. The Dow Jones lost 45%. At that time, De Beers was a listed company, and De Beers' share price was directly correlated with the Dow Jones. So you can imagine things were very difficult and very tight. And at the same time of that, there were the fantastic discoveries of Arapa, Letlhakane, and Jwaneng. So you can imagine the directors of De Beers at that time, that the exploration geologists were really producing the goods, but they were not selling the diamonds. And there was a large stockpile sitting in the Central Selling Organization in London, and you can imagine strategically what a problem this would actually be. So it's important to bear this in mind and look through this particular lens when you look at the discovery of AK6 in the late 60s. In the early 2000s, I call this the second generation of exploration technology. Debot went and had another good look at many of the older discoveries in the Arapa region. And this included AK6. It was chiefly assessed using, at that time, groundbreaking geophysical technology. And this illustrated the pipe was not 3.3 hectares, but in fact 9.5 hectares. And because of this immediately triggered what we call an evaluation program. And this evaluation program forms the next part of my presentation. The first phase of the evaluation program was 100-ton samples. And this was very, very common in all the kimberlites which had grown due to their geophysical signature at that time. This was 5 12-inch holes, and it gave a grade of 25 CPHT. Do you remember I asked you to remember at the very beginning, what was the dollar per carat? 500 and something, do you remember? Yes? Yeah, good. Well, look, it's now $124 a carat in the very first phase. But notwithstanding that, a project like this, which gave a grade of 25 CPHT and $124 a carat, was obviously of great interest to Debot. And that progressed immediately into an evaluation program. The first phase of the evaluation program was to define an inferred mineral resource and to try and fast track this and do economic studies at the same time. And I'm going to give you a brief slide on the economic studies momentarily. Here you can see we drilled 44 6.5-inch holes, 29 core holes, and 13 23-inch large diameter holes. You'll see the grade here has remained relatively consistent, sitting at 25 carats per 100 tons. And because at that time, the company was in a joint venture with African Diamonds, and I'm going to touch on the corporate side later, one had to deliver an indicated resource. And an indicated resource is something in which you can put into a feasibility study, which then becomes bankable, so you can raise project finance against this. The key point about this generation of the indicated resource is, and what I want to draw your attention to, is the absolute importance of generating 3,000 carats for your diamond assortment. And that is so you can get a good quality assessment of the size, frequency, and the value. Sadly, at this point, only 1,700 carats was gained. Now, hindsight is an exact science, and I'll illustrate how important that mistake was as we actually progress through the presentation. Quite interestingly, if you look at the bottom, the picture in the bottom right-hand corner, that's the ex-director of Exploration De Beers, Bill McKechnie, and the chairman of African Diamonds, John Teeling, where it was identified even at that stage that AK6 would be a great type 2 diamond producer. And in fact, there were 2 horizontal layers of type 2 diamonds. That piece of qualitative information was almost laughed at. Today, it's been proved in production. Just remember, again, qualitative information, and I'm going to come back to that a bit later on. I mentioned in my previous slide that we did, in parallel to the geological work, and I think it's very important, economic work at the same time, to assess where this project would go in the future. And I've illustrated here the 5 publicly available documents. Of course, African Diamonds, De Beers, and others would have done their own documents, which are not part of the public record. But what you can see from this slide, and you don't need to worry too much about the detail of the numbers, is the vast difference in the valuation of this particular project. You've got net present values ranging from minus $70 million, which is almost laughable in today's context, and I'll try and answer that question before I finish, to $209 million, which is even conservative by today's standards. So you can see this is a real mixed bag based on the technical information we had at this particular point in time. Just for your interest, the mine went into production on a phase 1, $120 million, so you can see which company actually got it closer in terms of defining what would eventually come about. The resource statements, in the same way as I followed through time the techno-economic statements and resource statements, what you'll notice from this is that the grade has remained relatively consistent, slightly lower because the bottom cutoff is slightly higher at 1.25 millimeter, but you'll see a gradual increase in diamond value from 130 to 180, and even 180 was conservative at the end of the day. And as we all know, the indicated resource statement is something which forms the basis for your technical and economic studies. Moving on to mining. This is a picture of the world-class Karowe mine, which is just down the road. And if we take that resource statement of 3 slides back and look at the reserve statement, the big thing I want to draw your attention to here is the diamond value. Here we're sitting at a probable reserve of 394 and an inferred of 412. So you can see as production comes in, on top of the sampling results, which generated a huge amount of data, the diamond value has almost tripled over the period of 3 or 4 years, to make something which was a sub-marginal project to being something with a very, very handsome payback. This is their production performance. So in addition to a much higher than average dollar per carat, consistent grades and consistent volumes, they produce the most magnificent large stones, which were qualitatively identified by De Beers right back in the inferred resource stages. So I'm going to jump now onto the corporate context behind the time, because I think it then sets the scene to merge the technical stuff with the corporate stuff in terms of the lessons learned. AK6 formed part of the Boteti joint venture, and the idea behind this joint venture, which was a joint venture between De Beers and African Diamonds, was that De Beers would put in their ground, African Diamonds would put in their ground, De Beers would be the operator, and with that, it would be a 51-49. On the release of a bankable feasibility study, and this is why the indicated resource is absolutely so important, De Beers would then earn 70%, African Diamonds will be diluted to 30%, and then it would be heads up and equally funded actually after that. So everything worked out swimmingly to begin with. However, and I'm not going to read through all of this on this slide, I tried to capture all the corporate points here on one slide, but I am going to draw out a few very, very important things. On point number 2, I alluded to it earlier, that because the 1700 carats did not meet the 3,000 carat threshold, De Beers had to be the bank, because you could not go to Stanbic or Standard Bank or anybody to go and convince them you had an indicated resource because you did not have 3,000 carats. So therefore, De Beers had to be the bank, and therefore they had to fund the project. So that's number one point, which was really important. Number three, some of you are a little bit older may have read about this, and it was a very, very traumatic time, I think, for all concerned, is that De Beers, and might find it quite strange now, applied for a retention license on the project because they felt it was sub-economic. African Diamonds launched a High Court action against them because we felt it was economic and you couldn't apply for a retention license on top of a mining license application. The courts decided in our favour and a mining license was granted. Thank God they did. And then in 2009, De Beers wanted to try and raise $440 million to build the mine. It was the time of the global financial crisis. I've got a slide on that later. It was annus horribilis. It was a horrible time. You couldn't raise any money. And therefore, they offered to sell it to us. And of course, African Diamonds being a small junior, there's no chance we had the money to do it. But in a happenstance telephone call, we got introduced to Lucara, and taken straight from one of their press releases, a loan was provided by an insider to the company of $49 million, which is what De Beers accepted for their 70% of the project. And just start thinking now what you think that economic return is, because I'll tell you that on my penultimate slide. And then, of course, Lucara wanted to take 100% of the project, so they actually bought out African Diamonds. Have a look at those dates and have a look at how they integrate with the technical history. So, what are the lessons learned from this? And I want to spend maybe a couple more minutes extra on this particular point. 2009, as I mentioned earlier, was annus horribilis. It was a global financial crisis. De Beers illustrated a 99% drop in net profits. So it was absolutely shocking. The size of their diamond stockpile was probably a week or two from not being able to be funded. Sales of rough diamonds were down 57%, global workforce cut by 23%, and junior funding just literally dried up overnight. And that's why we couldn't try and sell the project to other people, because no one had money at that particular point in time. But of course, the other part is nobody particularly believed a junior that this would work when a senior said it wouldn't work. You look at the graphs on the right-hand side, care of a Botswana pension fund presentation of 2009. The second major learning here is joint venture dynamics. It's a relatively kind of soft subject. I'll leave it to you to read the kind of table on the left-hand side. But what I've tried to do there is draw a comparison between how juniors see the world and how majors see the world. And just for your interest, I spent 21 years at De Beers, so I have a senior hat on, and I'm now running my 4th Diamond Junior. So I've got the scars now after running Diamond Junior companies. The very first point on the right-hand side I'd like to bring to your attention, a 10-month lag between sampling and results issued. You can't work like that in a junior company. With a large company, it's okay, because you've got a strategy and a very long-term plan. The joint venture agreement was signed before the release of the first bulk sampling results. That's a very, very interesting point. De Beers could draw on their reserves for funding. African Diamonds had to go to the share market to raise money from an equity perspective. And therefore, there was a substantial difference in risk, plant design, capital estimates, approach to financing, hurdle rates, decision processes, i.e. everything. A fundamental difference, notwithstanding the perspective that both African Diamonds and De Beers had very strong technical teams at that time. What I think was also a very, very important part of why Lucara is here today as well is that African Diamonds was not only listed on the London AIM market, but was listed on the Botswana Stock Exchange as well. And roughly 20% of African Diamonds shareholders were local citizens. And I think that's what turned this project from a retention license to becoming a mining license. And it just shows how important it is to try and raise your money in the country in which you're doing your business. The impact of technology, I've tried to distill this into one particular slide, but it all revolves around one point, and that is a significant underestimation of the large diamond population. And on the size frequency chart on the right-hand side, you'll actually see it. And why is that? And it's quite simply for two reasons. One is the undersampling of diamonds. If one had got 3,000 carats or more, you could have well have established a better size frequency. And absolutely importantly, and maybe one or two of my colleagues will be talking about this after me, particularly Jim, is the impact of diamond breakage. It's still not well known. And you can see what economic impact this has on the overall project. The geological model, interestingly, did not change that much from the very, very early stages all the way through to the end. The gross geology remained relatively the same, but the internal geology had a bit more granularity. So in terms of a lessons learnt here, that we got the geological model pretty right up front, I think. If you look at on the left-hand side, sorry, the right-hand side of the slide, you'll see the difference in diamond valuations. Now, mainly for my friends here from the university, is there are two methods of valuing a diamond. It's not like coal or gold or others where you can look it up in your newspaper. You have at one end of the continuum, you have a fixed price book, which is generally the best thing for long-term producers and large producers. And for smaller producers, you have an open tender system. And there can be as much as a 30% difference between the two in a rising diamond market. And equally, there can be a 30% difference between the two in a falling diamond market, but absolutely the other way. And so there's a lot of science behind this, but there's also a lot of art in that the value of a diamond is seen in the eye of the beholder, and the beholder here being your diamantaire. The mineral resource itself, you'll see over time from 2007 to 2013, the size of the resource has been relatively unchanged, the grade has been unchanged, but you see the massive pickup in the diamond value once you go into production. That just underscores much of what I've said already in terms of the undersampling of larger diamonds and the undersampling of the type 2 diamond population, which contributed significantly to the diamond value. Economic value, I wonder how many of you got this one right. Now, what does this all mean in terms of economics? Now, this is very, very important from a shareholder perspective. If you had invested your money at African Diamonds when it listed, and you still have your shares now, they would be actually Botswana Diamond shares, you would have made 25 times your money. So if you'd put in a pula, you would have 25 pula. If you put in 1 million pula, you would now have 25 million pula, plus you'd have got Botswana Diamond shares for free. Now, this is one of the reasons why, and I think Norman may have touched on this earlier, is why people get involved in this business. If you strike it right, and you have the right set of technical and corporate skills, this can make people a vast amount of money. And not only did African Diamonds shareholders did very well, and I haven't been able to work out how well Lucara shareholders have done because they've had successive dilution, but they have had a 40 times increase in their market capitalization. So putting it in money terms, that $49 million, which Lucara, through African Diamonds, bought 70% of AK6, that $49 million is worth just under $1 billion now, 6 years later. It's quite profound. It really is. I find this is quite profound. And this, to me, is part of the argument of when I go to the London market to raise money, is you've got to be in the right area, Arapa area, Botswana, you can't go wrong there. You've got to have the right team. You've got to be in a product, diamonds, which is great. And of course, you've got to have the experience and the knowledge about what you're doing. So, ladies and gentlemen, and my final slide is a conclusion. How do I try and wrap this all up? And I either like to put things in 3s or 5s. And this one, it had to be 5, I'm afraid. And I've split this into corporate and technical. The first point here is a different and contrasting strategy, corporate and financial agendas between De Beers and African Diamonds. They had different risk appetites, different ways of raising money, different approaches to mine development. Very, very different. And it's a fundamental challenge for majors who deal with juniors. The second part, and this goes in almost every business, cash is king. The insider to Lucara was able to fork out of his own money the $49 million at the bottom of the market to take the investment out of De Beers. De Beers did not believe it. But this man has made a fortune because he invests in people, and there was relatively little due diligence. I hope there are no lawyers and accountants here. He believes in the track record of the people who did the work, and he's made a phenomenal amount of money through this whole process. Different diamond pricing methodologies has a huge impact too as well. As I mentioned, there is a big difference between fixed pricing and the open tender system. And then from a technical perspective, I've mentioned this time and again, but it's a very important point to repeat, is there was a too small a bulk sample to begin with, and this led to deficiencies in the size frequency distribution and value modeling, and in particular, the poor understanding around diamond breakage. And let me say, the poor understanding around diamond breakage continues today. We know a lot more, but there is a huge amount more we still need to learn. And finally, and I think Manfred mentioned this as well about don't just look at computers. Go out to the ground, do ground truthing. The original workers there did not take into account qualitative information. If you couldn't put it into a computer and you couldn't model it, you couldn't use it. And I go back to the comment I made about a doctor of geology identifying these two significant layers of type 2 diamonds in AK6. And I also go back to, and I haven't mentioned this one, is that we reconstituted those type 2 diamonds because our top cutoff was 12 millimeters. So we knew as project managers at De Beers, and I have my De Beers hat on now, that it was going to produce large, high quality type 2 diamonds, but it couldn't be modeled and therefore it was ignored. So that qualitative information, that gut feel, that instinct is absolutely critical in terms of the development of a project. So there we are, ladies and gentlemen. Thank you very much indeed for your time, and I hope you've enjoyed a brief story of AK6, now the world-class Karowe mine.
And if it is, where the other bits are still to be found?
Manfred, I don't know enough about that because it was done after my time.
Oh, I see.
Yes, that was done under Lucara's management, so I can't really make a comment on that.
Okay.
Sorry.
The other part weighed 800 plus carats.
The two types of type 2 diamonds, is that the blue and the white? Or
They're mainly type 2A diamonds here.
you said there were two varieties of type.
Sorry, there are two layers of diamonds which were noted in the kimberlite pipe when we did the diamond layout.
Right.
So, horizontal layers going across the pipe, in particular the southern lobe. And Dr. Roby actually identified that, and that's actually come to pass in production.
We got time for another one? Jason, I'm not sure whether this is a question or a comment or a contribution to the challenges of these big diamond deposits. And I think I'll talk more to let's say than Karowe, because I know let's say from De Beers days, and I know let's say in its new life under Gen Mining. So I was involved, apart from working with De Beers at let's say in the 70s, I was involved in a technical team for Gen Diamonds at the time they bought let's say from JCI. Now, at that time, they had in the database the De Beers production records from the 1970s and early 1980s. The value side of that is irrelevant because of the dating, but the size frequency was very relevant. And they also had the benefit of 2 years of production under the JCI ownership. That then is a stronger size frequency distribution and the relatively current sales prices. All of that information went into modelling, if you like, an opinion on a value to bid in that bid process. And we all got it wrong. I think there were 5 or 6 bidders in a week, all came up with a similar number, but it proved to be dramatically wrong. And as well, again, did it privately and offered twice as much, which may have been wrong. But the point that I want to make in coming back to the size distributions and the value is that we all, I think, followed a practice of capping the value of the big stones beyond 10 or 100 carats as a factor of practicality in terms of computer models. And that comes to Karoi and the decision to use that, in a sense, risk discretionary decision to go beyond what the numbers can't tell you. You had a 3,000 carat parcel at Letseng. By that time there was 40,000 carat parcel. Still didn't have the answer to the question, what is that value curve as you get into the bigger diamonds? And the only way to make a value decision on acquisition is to get into that discretionary environment. And it's very nice for Botswana, for Karoi, for Lucara, that the right decision was made in the end. Congratulations for everybody who's been involved in that.
I would just like to make one comment. In my last job, I ran Rockwell Diamonds, and Rockwell Diamonds' business was in the recovery of large, high-value diamonds, and without it, there was actually no business. So there is a way of being able to generate these size frequency distributions, and there is a way of being able to generate the diamond values associated with it. But you've got to have the courage of your convictions and allow that extrapolation to take place over 100 carats and beyond. And we did that in Rockwell, and we were able to pay our costs, and 80% of our value came from plus 20 carat stones, where we'd only recover half a dozen a month. And that's mining 750,000 tons a month as well. So in hindsight, what we want to have done here, definitely use the qualitative information. It was available, and I gave you 2 very nice examples of it. And then not stop the size frequency at 10.8 carats. Continue it going and continue modeling it, and have the courage of your convictions both through extensive data and extensive experience as well.
You said in one of your slides that the value of a diamond is seen in the eyes of the beholder. I copied down, if I copied it down well.
You did?
Yes, okay. So what I want to know is, like, what are the features that stand out when differentiating between a fake diamond and a real diamond, and if there are any methods that are used?
Okay, my comment there was not associated between fake and real diamonds, and there are no such thing as a fake diamond, by the way. It's called a synthetic or a moissanite or something. It's either a diamond or it's not a diamond. And a diamond is a naturally occurring substance. Sorry, that's De Beers dogma coming out for you. But it's fine. What I was referring to there is, if you're a diamond cutter and your friend next to you is a diamond cutter, and you both get a 10 carat stone, you will see a different shape in it than your friend will. And that different shape, call it a 6 carat princess cut, would go for N million. Your friend here would maybe see a 5.9 carat tabular cut, which would go for maybe something 20% more. And that's how diamantaires get their margin, is they're able to actually look into the stone, both using their own experience and also technology to see what is the maximum yield they can actually get from it. And that's typically the advantage of when you go for an open tender system, is that the diamantaire can evaluate every single stone and get as much value as he or she can from it. Whereas a price book system is, that's the price, take it or leave it. Does that make sense?